The Dow 381 in September 1929. Then it sank to 41. That is an 89% fall. The boom ran on borrowed money. Margin made tiny cash control huge bets. The ticker fell behind the selling. October 29th, 16 million shares traded. The sellers were not waiting. Bank doors would shut next. Then soup lines, then Senate files. Rewind. It started as optimism. In the 1920s, cars, radios, telephones, and electric appliances made the United States look newly modern. Business pages felt like science fiction with dividends. The Dow rose from 63 in August 1921 to 381 in September 1929. Prices did not just climb, they taught people to expect climbing. Brokerage houses and investment trusts brought more ordinary Americans into the market. Ownership became a national conversation, often conducted through borrowed money. The era had genuine growth and real new products. That is why the story worked. A bubble is most persuasive when it borrows facts from a boom. The clean sales pitch was simple. Modern America was getting richer, and a share certificate was a ticket onto the escalator. But an escalator built on borrowed cash has a peculiar emergency exit. It is called everyone trying to leave at once. Margin let a buyer put down only a fraction of a stock purchase, often around 10%, while the stock itself served as collateral for the loan. If the price rose, the buyer kept the upside on a much larger position. The arithmetic looked wonderful because the ladder was moving in the right direction. If the price fell, the broker could demand more cash or sell the shares. A margin call was not an opinion. It was a deadline with a telephone. Commercial banks and other lenders poured increasing sums into broker loans. Credit did not merely watch the boom, it helped pull the cart uphill. This is the hidden crack in one picture. A small drop can force sales, and forced sales can make the drop larger. The staircase becomes a slide. Even the channel lizard would have noticed the floor was missing. It is difficult to diversify a staircase after it turns vertical. Federal Reserve leaders were worried that speculative credit was diverting resources from commerce and industry. They disagreed over what to do about it. New York repeatedly asked to raise its discount rate. In August 1929, the Federal Reserve Board agreed, and the New York rate reached 6%. Higher rates did not politely deflate the market. The boom continued, while the international gold standard spread tighter money pressure beyond the United States. In October, economist Irving Fisher said stock prices had reached what looked like a permanently high plateau. History has a brutal sense of timing. There were skeptics, too. Earlier that autumn, Roger Babson warned that a crash would come. Warnings are easiest to hear after they become captions. By September, prices were already lurching down and snapping back. The market had begun to rehearse the panic without calling it by name. On September 3, 1929, the Dow closed at 381.17, its pre-crash high. The line on the chart had become almost too steep to fit on a page. The New York Stock Exchange was a temple of numbers, but the numbers represented promises, loans, collateral, and confidence, all things that can change together. Some prominent financial leaders still encouraged people to buy equities. In October, bankers even bought blocks of shares at high prices to restore confidence. That rescue attempt did not stop the selling. Confidence cannot be stapled to a ticker. It has to be believed by the person holding the next sell order. This was the peak's final trick. The more frantic the effort to prove normality, the more visible it became that normality had left the building. The next chapter is not a mystery. It is a door opening onto a trading floor where everybody wants the same thing: out. On October 24th, Black Thursday, a selling frenzy hit Wall Street. The market was shaken, but a banker's buying pool briefly steadied prices. That pause was not a cure. It was a breath held too long, while margin calls and fear kept passing from broker to customer. On Black Monday, October 28th, the Dow fell nearly 13%. The next day, Black Tuesday, it dropped nearly 12% more. The ticker lagged behind the actual trading. People could see printed prices, but they could not be sure those prices still existed by the time the tape arrived. By mid-November, the Dow had lost almost half of its value. The great autumn sell-off was real, fast, and terrifying. But it was not the entire depression. That distinction matters. The crash damaged spending and confidence, but the deepest catastrophe still had more chapters waiting in the banking system. In the fall of 1930, bank failures turned a recession that had appeared capable of recovery into the beginning of the Great Depression. The Bank of United States failed in New York on December 11, 1930, with deposits of about $200 million. Its name was misleading. It was a commercial bank. The FDIC records won 350 bank suspensions in 1930, 293 in 1931, and roughly 4,000 in 1933. Those are closed doors, not abstract dots. In September 1931, Britain left the gold standard. Gold and currency pressure increased, and the banking crisis became nationwide in the United States. By March 1933, the commercial banking system collapsed, and President Roosevelt declared a national banking holiday. The stock chart was now only one panel of the disaster. A market crash can frighten people. A bank panic can change whether people can pay wages, cash checks, or keep savings where they are. That is the domino chain. Families cut purchases, firms slowed production, and unemployment rose. The economic cost did not arrive as one cinematic explosion. It arrived as ordinary plans becoming impossible. By 1932, the Senate's history notes that nearly 1/4 of Americans were unemployed. A percentage is cold. A job search in a soup line is not. The human cost belongs in this story because it prevents the crash from becoming a neat chart trick. Losses were borne by people who had not designed Wall Street's plumbing. The downturn was national and then global. Industrial production fell, trade contracted, and the Depression became the longest and deepest downturn of the modern industrial economy. There is no punchline for the people in these photographs. The absurdity was reserved for a financial system that treated confidence like an unlimited resource. To understand what changed next, follow the receipts, hearings, documents, and a public demand to know who had sold what to whom. In 1932, the Senate authorized an investigation into stock and securities practices. Its later chief counsel, Ferdinand Pecora, gave the inquiry its popular name. Pecora used subpoenas and internal records to examine the nation's biggest financial institutions. The hearings made practices once hidden in ledgers visible to the public. National City Bank Chairman Charles Mitchell testified. The Senate history says the investigation exposed loans and conflicts that had fed the culture of speculation. Reforms followed. The Banking Act of 1933 separated some commercial and investment banking activities, while federal deposit insurance began in 1934. Deposit insurance did not erase risk or pain. It addressed a specific terror of the early 1930s, that a panicked rush could destroy a bank and trap ordinary depositors. The lesson was not that a single villain pushed a red button. It was that incentives, leverage, weak safeguards, and fear can combine into a system-wide failure. The 1929 crash was the loudest falling number, not the whole depression. It helped break confidence. Banking panics and policy failures made the fall much deeper. That is why the story still matters as history. A boom can be real, a warning can be visible, and a system can still be fragile underneath. The final number, 381 to 41. The final image, not just a red line, but the chain of lives and institutions attached to it. If this money story changed how you see the past, tap like and subscribe for the next rise, crack, and collapse. History is not financial advice.